Hey Puppy Trade! I wanted to do a video analysis update on my favorite stocks for me personally, just me, to buy and hold shares of for June 2021 and beyond. So before I get into it, I do want to say that I do understand today is Memorial Day, and the last thing that I want to do is contribute to the commercialization of an American holiday, especially the one that honors the servicemen and women who have made the ultimate sacrifice of fighting for this country and fighting for the freedoms that we get to enjoy every day. So I also want to say thank you so much to those individuals. Thank you so much to the family members of those individuals. And thank you so much to the current and former members of our armed forces. As respectfully as possible, I didn't think it would be fair to the viewer to post a video like this during the middle of the trading week. A lot of people are going to say, puppy trades, SPY's at 420. Why are we talking about potential long-term investment opportunities? Shouldn't we be digging a bunker, getting ready for the next big crash, right? And that's why we talk about, the reopening sector, the travel and leisure sector, and the oil sector, so much to show that they really, have a lot of evidence that in the short term as well as the medium term, they've got a lot more upside. It doesn't make sense to be calling for a super crash, while oil and, travel and leisure stocks are ripping. So this is oil sector XLE. This is a wave one. As an ABC correction, it puts in a wave two low. The 161.8% extension of wave one is the wave three target. It has not been reached yet. So this wave three is subdivided cleanly into 5 waves, where the length of wave one placed at this wave four low will take XLE all the way to 61, which is exactly the 161.8% extension of wave one. It's worth noting that would not be quote unquote the top. We'd have a shallow wave 4 correction and then go on a 5th wave higher. That would be at least the length of wave 1. So oil stocks clearly have much more upside, and the oil sector has already broken above this early March high. So let's talk about that for a second, because I saw something this weekend that really made me sad. A wave theorist who I really respect, they said their primary expectation for this week was that SPY was completing an ABC correction from this high. So their primary, objective for this week is that SPY is going to go, on a wave C down to about 402. Now, why is this incorrect, right? Obviously, everything's possible, in the realm of trading. But why is this incorrect from an Elliott wave perspective to have your primary, objective or, projection be that SPY is going to take another wave C lower, right? There is a right answer, and see if you can figure it out. Okay, the reason that this is wrong to have this as your primary, your primary scenario is because the German stock market index, the DAX, has already broken above this high, right? Spain's stock market index, the IBEX, has already broken above this high. The S&P 500 healthcare sector ETF, XLV, has already broken above this high. We have seen just this week that Nvidia and Facebook broke out to new all-time highs after participating in this sell-off, right? And that's not to mention all these reopening stocks that clearly have, much more upside. So that's why you can't stare at SPY all day, right? Because if you stare at SPY all day, you're going to miss what the rest of the market is telling you. Oil stocks clearly have more upside, right? Now, while we're on the subject of SPY, in the bigger picture, we talk about this a lot. In other videos, I really go through the smaller degree counts. I just want to remind you guys what I think the bigger degree count is. This is a wave one, and an ABC correction puts in a wave two low. The length of wave one placed at this wave two low will take the S&P 500 all the way to 460. So 460 is the summer destination for the S&P 500. Okay, the shorter term, counts that I do in other videos is figuring out how we're going to get there. Okay, but the larger degree count, the destination for wave 3 is clearly the length of wave 1 placed at this wave 2 low. That's going to take SPY all the way to 460. Okay, and we have a lot of evidence besides SPY from the XLE, ETF that oil stocks are going to go much higher, and also a lot of reopening stocks like Disney are going to go much higher. So this is Disney, very clear wave 1, wave 2, wave 3. An ABC correction puts in a wave 4 low. The length of wave 1 placed at the wave 4 low is going to take Disney all the way to about 216, right? So Disney clearly, has more upside. The oil sector ETF clearly has more upside. We haven't talked about this chart a lot. This is Wyndham Hotels. So I've talked about, a lot of reopening stocks. This just has a really pretty count in the reopening sector. This is Wyndham Hotels, ticker symbol WH. This is the 161.8% extension of wave one. So this is the wave one. This is the wave two low. The 161.8% extension of wave one takes Wyndham Hotels to 80. Okay, that's also the length of wave one placed at the wave two low. So I believe Wyndham Hotels clearly has more upside to 80 to complete this wave three. That wouldn't be the top. We'd have a shallow wave four correction before going on a fifth wave higher. That would be the length of wave one placed at the wave four low. And that would conservatively take Wyndham Hotels all the way to about 104. So Wyndham Hotels has more upside in the reopening sector. So does Disney. So does the airline ETF Jets, JETS. So we talk about American Airlines, United Airlines, Boeing a ton, right? But this is just the airline ETF JETS. This is wave one and wave two. And the 161.8% extension of wave one is 28. That is exactly where wave three ends. So when people say they don't believe in wave theory, it's like you have to know that this is the 161.8% extension of this large move, because that is exactly where wave three ended. You also had to know that the 23.6 to 38.2% retracement of wave three was where wave four usually ended, because that is where wave four ended. And now you have to know that the length of wave one placed at the wave four low will take JETS all the way to 35. Okay, so Jets, the airline ETF, is going about 9 points higher. Doesn't make sense to be calling for a crash and SPY while that's happening. Okay, another reopening stock I really like. I haven't talked about this one. This is a gorgeous chart, man. I love this chart, especially for those who like to focus on, uptrend stocks. This is SeaWorld, ticker symbol SEAS. This is just so pretty. I believe this is a wave one, an ABC correction puts in a wave two low. Then SeaWorld goes on a wave three rally and puts in a wave four low at this low of about 46. So for a wave four, you're typically going to look for that sideways, kind of bull flagging action. And I believe now SeaWorld is going to hold above 46. It's also going to hold above this low of 49, right? Those are the levels. And if we're above 46 to 49 for SeaWorld, then wave five will either be the length of wave one placed at the wave four low, or what I believe it will actually be the length of wave three placed at the wave four low. So if it were the length of wave one placed at the wave four low, we're going to see SeaWorld in the next 4 or 5 months pretty conservatively reach 67. I actually think that's a little too conservative. The length of wave three placed at this wave four low will take SeaWorld all the way to 72, right? So the reopening stocks, they clearly are giving a lot of evidence. They're calling for a major crash in the stock market right now. You're going to look a little silly. Right now, June historically, is a little bearish for the stock market. So, I don't think this is the time for bulls to be beating their chest, but there's a lot of evidence from the oil sector and the reopening stocks that they are not done in the short term. Okay, so let's get into, some boring stocks. Okay, we're going to start off this video with the boring stocks, because a lot of times what I'll hear, it just breaks my heart. Someone will say, I'm an oil bull, or I'm a precious metal bull, or I'm a crypto bull, or I'm a tech bull, right? And I'm bullish all of those sectors, but I'm not only bullish all those sectors. And when you could, define yourself and confine yourself into one sector, then what you're asking for is exactly what happened last quarter, where, a sector you're not in, like the value stocks, the airlines, the banks, the tanks, the oil stocks, the industrials, they're outperforming. They have all the money. And even while the Dow Jones is ripping, you're sitting there with your hand in your pockets because, you thought that their fundamental pictures were too boring. Okay, so don't confine yourself to any one sector. Okay, my favorite stock is the one that has the least correlation to the rest of my portfolio. So let's talk about some boring stocks right now. We're going to talk about some dividend stocks. And the reason is because, there's a lot of material, on YouTube and Twitter about, compound interest and, passive income and stuff like that. And that's extremely important, but it's really not as cookie cutter as, the internet would like you to believe. A dividend opportunity is extremely rare because you not only have to find a stock that pays a reliable dividend, you also have to have a setup on that stock where there's a high probability that it's going to appreciate in value, while you're holding shares. So this is LTC Properties. this is a REIT, so this is what is called an unqualified dividend, right? So I'm not a certified financial advisor. I'm definitely not an accountant, okay? I'm not a CPA. All dividend investors have to really understand the tax implications of the dividends that they're receiving. But this is a stock, it pretty reliably pays a 5% monthly, dividend, and it has a pretty clean count right here. So this is LTC Properties, ticker symbol LTC, wave 1, ABC correction puts in a wave 2 low. And then LTC Properties breaks above the wave 1 high. So the wave 3 target is the 161.8% extension of wave 1. That's going to take LTC Properties to about 55, and that wouldn't be the top. We'd have a shallow wave 4 correction before going on a 5th wave higher, which would be the length of wave 1, place of the wave 4 low. I think pretty conservatively in the coming years, and this is actually one where an investor hypothetically will want it to take longer for LTC Properties to reach 65, because they would be able to collect more dividends along the way and then have that final taxable event when they cashed out at 65 hypothetically. So this is LTC Properties wave 1, ABC correction wave 2. The 161.8% extension of wave 1 is 55. From there we'd have a shallow wave 4 correction. I believe there's a pretty clear path that will take LTC Properties, in the coming years to 65, and this stock pretty reliably pays a 5% monthly dividend along the way that I believe will grow in value. So, this is a really nice dividend opportunity. For now, bulls want to see, this low of 32 hold, LTC Properties above 32, it goes to 55, has a shallow wave 4 correction, then goes to 65 and pays a monthly dividend along the way. So here's two other stocks I really like in the dividend sphere. This is Pfizer. We talked about Pfizer a lot. I thought Pfizer was going to run off. I believe Pfizer below 40 is a gift. Okay, this is a wave 1, an ABC correction puts in a wave 2 low. Then Pfizer goes on another wave 1, has another wave 2 correction. What you're going to notice about Pfizer is this gorgeous Andrews pitchfork. So in Elliott wave theory, when you have a clear wave 1 and a clear wave 2, connect the beginning of wave 1 with the high of wave 1 and the low of wave 2, and just look at this pretty pitchfork. For Pfizer, all these reactions on the median. Now Pfizer is bouncing off the lower bound of this pitchfork. It's going to go all the way to the median of the pitchfork in the longer term cycles. So this is wave 1 and wave 2. This is wave 1 and wave 2. I believe Pfizer has been forming a base or an Elliott wave nest for 20 years. The length of wave 1 placed at this wave 2 low is going to take Pfizer all the way to 63. It's worth noting that wouldn't be the top. That'd be the conservative wave 3 target. Then Pfizer would have a shallow wave 4 correction and go on a 5th wave higher into the 80s, even into the 90s. But I believe the best target for Pfizer is that it will hold above this low of 33 and hold above this low of 27. So those are the downside levels that we want to stay above. If it's above those levels, it will go from the lower bound of the pitchfork to the median of the pitchfork, and it will pay most likely a dividend along the way. So it is possible that a company, cuts their dividend, a la AT&T. That's why, these dividend setups are so rare. Pfizer does have 30 years of dividend history. It also has a very clear path where it will go from the lower bound of the pitchfork to the median of the pitchfork. The next stop is 60, and I believe eventually the 80s and the 90s are, on deck for Pfizer, and it will pay a dividend along the way. So I love Pfizer in the longer term picture. I also love Merck, another pharmaceutical giant. I like these as diversification plays, a lot too, where this, just like Pfizer, is a 1, 2, 3, 4, 5, large degree wave 1, an A, B, C correction puts in a large degree wave 2. You connect the beginning of wave 1 with the high of wave 1 and the low of wave 2. Very conservatively, the length of wave 1 placed at the wave 2 low will take Merck to about 109. I do think that's too conservative. I think really Merck is going to go the length of wave 1 placed at the wave 2 low, and Merck is going to hold above 65 and go all the way to 136. This also has 30 years of dividend history. So I've got Pfizer and I've got Merck doubling at the very least in the longer term cycles. I've got both of them going to the median of this pitchfork and paying a dividend along the way. So now let's get into the slightly less boring side of this video. We're going to talk about some inflation vehicles. Now, a lot of times when I talk about inflation vehicles, the most common question I'll get is puppy trades. My uncle gets drunk at Thanksgiving and he talks about how the interest rates are 0, and he's been doing that, for the past 10 years, right? So why is inflation different, this time? Why should we be concerned about inflation besides obviously, all of the stimulus checks and stuff like that? Well, when your uncle is talking about When your uncle's talking about the interest rates being zero, he's talking about the borrowing side of the equation, right? And that is an important side of the equation. And the stimulus checks are also very important, right? The spending bills and all that, right? But that's not too different, right? What's really the dramatic change, right? Perhaps why we've seen such a huge increase in gas prices, and why we've seen such a huge increase in, the price of lumber, right? In 2020, the best trade, was lumber, right? That should be very scary because lumber is just wood, right? And they'll give you plenty of reasons like, people are flocking to the suburbs. But really the reason the price of lumber is going up, like, we're not stupid. It's because the value of the dollar is going down, right? So this is silver. I believe silver very conservatively will go the length of wave 1, placed at the wave too low. This is a 10-year basing pattern for silver. It's worth noting wheat and precious metals and the price of gold itself, spot gold, they've already broken above this 2011 high. They've already confirmed that this was all, years and years of basing. And silver is going to go the length of wave 1, placed at the wave too low. I believe silver very conservatively is going to go to 50. It's going to go to the median of the pitchfork, and it's going to confirm that this was all basing. So why on earth would that happen, right? Why is the price of, gas going up so much? Why is the price of lumber exploding, right? My uncle's been talking about interest rates being zero for years. Well, he's talking about the borrowing side of the equation. What a lot of people don't talk about, what the financial media really doesn't want you to know about is the lending side of the equation. So, I'm not here to give a finance lecture. I'm not pretending to be, some fundamental genius, but Modern Money Mechanics is a, booklet that's about 40 pages that was, released in the 90s, and it's written by the Federal Reserve Bank of Chicago. And it basically just attempts to, in the clearest way possible, explain how our money system works. This is a very important read. I love this document. It's written by the Federal Reserve Bank of Chicago. None of this is my opinion. Okay, absolutely none of this is my opinion. We're just going to talk about the lending side of the monetary expansion equation very quickly, okay? So there's a section on page 4 of this document that says what limits the amount of money banks can create, right? Very cut and dry. What on earth limits the amount of money that banks can create? And down here it says very clearly, right? We have a fractional reserve banking system. So it says that expansion cannot continue, right? Monetary expansion cannot continue beyond the point where the amount of reserves that all banks have is just sufficient to satisfy legal requirements under our fractional reserve system. So, for example, if reserves of 20% are required, deposits could expand only until they were 5 times as large as reserves. So it says reserves of $10 million can support deposit expansion of $50 million, right? And it says very clearly, this is the most important part, this is the whole point, the lower the percentage requirement, right, the lower the required reserves ratio, the greater the deposit expansion that can be supported by each additional reserve dollar. Thus, the legal reserve ratio, together with the dollar amount bank reserves, are the factors that set the upper limit to money creation. So this is not my opinion, right? This is the Federal Reserve telling you the lower the required reserves ratio, the greater the deposit expansion that can be supported by each additional reserve dollar, right? So what is the required reserves ratio, and why might it be different this time for inflation bulls, right? That's caused this, just explosion in lumber prices and gas prices, right? Well, very clearly from the federalreserve.gov, it says, as announced on March 15th of 2020, the board reduced the reserve requirement ratios to 0%. Effective March 26th, this action eliminated reserve requirements for all depository institutions. So there is no cap on institutional lending right now, right? That's basically what it's saying is it's lend away. There's really no cap right now on monetary expansion from the lending side of the equation, right? So that's why it's different. It's not about the borrowing side of the equation, the interest rates. It's about the lending side of the equation. Right, so let's look at the price of silver. The price of silver is going to go the length of wave 1, placed at the wave too low, and it's going to go all the way to 50, and that's extremely conservative, right? So if the price of silver is about to double, then that is extremely scary for any investor who has their entire life savings denominated in US dollars, right? So silver is going to double, right? And it's not just silver. The price of cotton, right? All of your expenses are about to become dramatically more expensive. People are complaining about inflation now. Inflation has not started. Inflation has not started. We will be seeing hyperinflation, okay? And I'm sorry that I'm the first one to tell you, okay? But this is the price of cotton. So these are cotton cash futures, CTY00. The clothes that you wear are about to become dramatically more expensive, right? Your school uniforms for your children are about to become dramatically more expensive. This is cotton, okay? This is a wave one, and I actually don't believe that this lower leg is going to happen, okay? I don't believe we're going to break below 75 on cotton futures. I believe that this wave two is in, and that cotton futures are going to hold above this low of 75 and go very conservatively the length of wave one placed at the wave two low. So cotton futures are going to go from 79 to very conservatively 121, right? So the price of cotton is about to explode, right? Some of the investment opportunities right now, that I'm really looking for a little lower are in the textile, and fabric producing corners of the market. Okay, that's pretty rare. Okay, but cotton, the price of the clothes that you wear are about to become dramatically more expensive. Okay, this is wave one. This is wave two. Cotton above 75. This is going to more than double. Okay, and if you're unprepared for this, your employer will not compensate you for this dramatic increase in all your expenses. Okay, well, public trades, I don't wear clothes, right? I live in, Austin, Texas. Okay, well, I hope you eat bread. Okay, this is the price of hard red wheat. So this is the price of hard red wheat. Ticker symbol IYH. This is the cash, index for hard red wheat. This is bread, right? This is the bread you eat. I used to do meat, but then people would be like, I'm vegetarian. I don't care about meat going up. All right, bread, right? You got to eat bread. Okay, this is a wave one. An ABC correction puts in a wave two low. You connect the beginning of wave one with the high of wave one and the low of wave two. The price of bread is about to explode dramatically. Okay, so this is a wave one. This is a wave two. The length of wave one placed at the wave two low, very conservatively, is going to take the price of bread from the lower bound of the pitchfork to the median of the pitchfork. You will see the price of bread more than double. Your employer will not compensate you for this, right? He or she did not compensate you for the increase in your gas bill, right? They're not going to compensate you for the increase in the price of your clothes or the increase in the price of bread, right? So when you ask puppy trade spies at 420, why are we talking about long-term investing opportunities? It's because really that's the only way that investors will protect themselves from inflation. So the direct way, most direct way, and probably the most, the best direct way for an investor to protect themselves from what I believe will be very, very serious inflation are silver and gold mining stocks, particularly the silver mining stocks. So let's just look at the bigger picture right now. This is SIL. This is an ETF composed of large cap silver mining companies. Okay, this is a wave one. An ABC correction puts in a wave two low. SIL goes on another wave one and another wave two. And now, right now, it is going on this wave three higher. Right, SIL is going to go very conservatively to about 48. This low of 30, it's going to go all the way to 78, my bad. In the longer term picture, this low of 38 is what bulls want to hold for now. So if SIL, the silver mining ETF, is above 38, then it is going to go all the way to this wave three target of 78 in the coming years. This could happen a lot quicker than people think. Okay, this could happen a lot quicker than people think. And I'm telling you right now, investors and traders and average Americans, they don't want to be thinking about inflation when silver's up here. They want to be thinking about inflation and how they're going to protect themselves when silver is right here, right? Because I'm telling you, once silver gets above 50, that's not going to be the top. Okay, that's going to be a huge base breakout. All right, and that's going to be very scary for people who have their retirement denominated in US dollars. So that's silver. This is SIL. Very, direct, I think really good way for investors hypothetically to protect themselves from inflation. SIL above 38 is going to 78. That wouldn't be the top. It'd have a shallow wave 4 correction, go on a fifth wave higher, and it would break this 2011 high. This 2011 high, wheat and precious metals has already broken. This 2011 high, the price of spot gold has already broken, right? They've already confirmed this is a huge base, right? The precious metals are about to do what the cryptocurrencies did in the fall, okay? You heard it here first. These silver miners, the price of silver, they're going above this high, and they're not stopping there, okay? That's SIL, probably the outperformer. It's going to be SILJ. So SILJ, wave 1, wave 2, wave 1, ABC correction, wave 2, another wave 1, and another wave 2. I know that just sounds like I'm just saying 1 and 2 all over, but if you connect the beginning of wave 1 with the high of wave 1 and the low of wave 2, look at this gorgeous reaction on the median of this pitchfork, right? So SILJ, right, will probably outperform SIL. SILJ will probably be the most direct way for investors hypothetically to protect themselves from inflation. SILJ will go the length of wave 1 placed at this wave 2 low, very conservatively going to 25. And that is honestly way too conservative. But right now, the next stop is if SILJ is above 12, it is going to the median of this pitchfork very conservatively. It is going to go to 25. But what, the bigger point of that is when SILJ is at 25, it's going to be above this August 2016 high. It's also going to be above this January 2013 high. It's going to confirm, that this was all a decade of basing and institutional accumulation. Okay, SILJ is going to go very high with silver. It's probably going to be, the best, outperformer, in the precious metal sphere of the market. So 2 individual names that I like. This is Btg Gold Corp. I've talked about this a little bit. I think it's ready. I really do think it's ready. I like this one. It's a wave 1 and a wave 2, another wave 1 and another wave 2, another wave 1 and another wave 2. I think we're going to see that this low of about 4.16 for ticker symbol BTG. Okay, this is not the cryptocurrency BTG. I got asked that question the last time I talked about it. This is not the cryptocurrency BTG. This is BTG, the gold miner, Btg Gold Corp. All right, not the cryptocurrency. This is going to go very conservatively, the length of wave 1 placed at this wave 2 low. Btg Gold Corp, is going to go dramatically higher. Probably a nice direct way, for investors hypothetically to protect themselves from inflation. The next stop for Btg Gold Corp is 9.52. I think that's probably going to be hit, close to the end of the year. But I really think, more the silver miners and the gold miners, these are really long-term holdings, right? I know everything in this video is long-term holdings. We'll get to swings in other video. Okay. This is the, this is where investors play the long game right now, but I do believe Btg Gold Corp is getting ready, and all these silver miners and gold miners they're going to surprise a lot of people this summer. Okay, they will. The length of wave 1 placed at this wave 2 low takes Btg Gold Corp from 5 to about 9.52, damn near doubling, right? That's the conservative wave 3 target. It goes the length of wave, it goes on the length of wave 1 again, placed likely at the wave 1 high. Typically, where am I getting these wave 5 targets? Typically in Elliott wave theory, the wave 4 will retest the high of wave 1, right? That's, generally, especially when you're completing a wave 2, it's a little far out to forecast what a wave 5 is going to do. Typically, a wave 4 is going to end up coming close to retesting the high of wave 1, okay? So if it did, the length of wave 1 placed at that wave 4 low would be the wave 5 target. We'd see Btg Gold Corp, around 12 or 13, right? This is a company that mines gold, right? This is not a SPAC. This is not a biotech company. This is a company that mines gold that is very conservatively going to double, okay? That should be very scary for investors who have, their funds in, denominated in US dollars, okay? So I think one question investors have to ask themselves is, are cryptocurrencies and are precious metals, should they get special treatment? I believe they should get special treatment. I really do, because they are the most direct ways that investors will be able to protect themselves from inflation. So this is Sandstorm Gold, ticker symbol SAND. I'm not even sure I like this one as a swing. I really like this one as really just more evidence that, the gold mining sector is going to go much higher. Very, small dollar amount right now. This is a wave 1, and ABC correction puts in a wave 2 low, ticker symbol SAND. Very conservatively goes the length of wave 1, placed at this wave 2 low. It's going to go all the way to, 15. The real reason that and this is the larger to recount, right? Very similar to BTG, where this is a big nest. We're going to see, Sandstorm Gold, ticker symbol SAND, go much higher. But I really just like this Sandstorm Gold chart because there's a lot of evidence, that we're going to see. So what this look like? This would be the wave 3. We would clone this tool, for our wave 5 target, placed at the wave 1 high, and it would look something like this for Sandstorm Gold, where it goes from 8 to 18, right? I'm really just showing this as more evidence that gold mining stocks are about to double, right? And that's scary. You know, these aren't solar energy companies. These aren't SPACs, right? They are companies that mine gold, and they're about to double. That should be scary to a lot of people. But I think Sandstorm Gold looks something like this, you know, in kind of the shorter term picture, not like the shorter term picture, but the smaller degree count, where it goes 1, 2, 3, has a shallow wave 4, and then a wave 5 could take Sandstorm Gold from 9 to 18, another gold mining stock that's about to double. But this is the real reason I've got Sandstorm Gold in this video. You connect the beginning of wave 1 with the high of wave 1 and the low of wave 2, and this is just too pretty. Look at this. Gorgeous reaction on the median of the pitchfork. More gorgeous reactions on the median of the pitchfork, but man, that's a beautiful reaction on the median of the pitchfork. We're going to go from the lower bound of the pitchfork. Now we're on the way to the median of the pitchfork, and we're going to see, you know, Sandstorm Gold, it's also going to break above this high. It's going to confirm that this was all basing. I love Sandstorm Gold. You know, in the very short term, bulls want to see it hold above 5.97. So we're going from, you know, boring to sexy. We're starting to get into the slightly sexier stocks in this video. All right, this is Credit Suisse. I talked about Credit Suisse a lot. Now, it's important to realize Credit Suisse might be getting into leap candidate territory, okay? But I also, before we even look at the Credit Suisse chart, this is a regional bank, okay? This is a regional bank. I imagine a lot of the, you know, traders or investors watching this video don't have a lot of exposure to regional banks or financials, okay? So I love stocks that have low correlation to the rest of my portfolio. Credit Suisse, Pfizer, Merck, silver miners, I think those will do a good job, okay? So this is Credit Suisse. Before we look at the chart, let's look at the price overview real quick. I love, you know, when a stock has just reached the very bottom of its 1-year implied volatility range, the options market, you know, letting you know it's ready for a huge move. Then you use wave theory, you know, technical analysis, sector analysis to see, will that move be to the upside? But right here, always, you know, when you look at a stock, go to the price overview, just scroll down a little bit to the options overview and see when was the 1-year implied volatility low put in. For Credit Suisse, that was put in on May 26th. That Credit Suisse was at the very bottom of its 1-year implied volatility range. That means option premiums were at the very cheapest, and implied volatility is mean reverting. So Credit Suisse is ready for a huge move. Spoiler alert, the wave theory says it's going to be to the upside. So this actually might be a leap candidate, but I really like it, you know, as a long-term hold. So for Credit Suisse, I believe this is the wave 1, and then, you know, we don't talk about expanded flats too much, but I really believe this is an expanded flat where this is a wave A. Wave B breaks above the prior high of wave A. That's all it really means. And then there's a wave C lower. So all an expanded flat is an A, B, C correction where wave B breaks above the high of wave A. So I do believe this is an expanded flat. I believe Credit Suisse has put in, I mean, this is more than 20 years of basing for Credit Suisse right now. I love this as a generational bottoming play for a huge bank, and this is just extremely pretty. In the longer term picture, I believe, you know, the size of wave B placed at this wave 2 low, which is also the wave C low, is going to be the next, you know, longer term target. So this length of wave B placed at this wave C low, which is also the low of this, you know, super cycle wave 2, is going to give us our next target. As crazy as it sounds, in the coming years, right, the next, you know, several years, Credit Suisse is going to go all the way from about 11 to 72, right? I've got Credit Suisse going to 70, you know, pretty conservatively, and that's just the wave 3 target, right? Once Credit Suisse breaks above this wave B high from 2007, it will confirm that this was all basing. And you can kind of see with the volume patterns right now, this was being heavily accumulated, you know, towards the bottom of this, you know, kind of falling wedge pattern. I think we've seen our huge selling climax, right? They gave you that little story about Credit Suisse, right? No one ever talked about Credit Suisse until it was the absolute perfect time to buy. You know, they gave you this, you know, BS story about, you know, some, you know, fund manager who got liquidated on leverage, right? They always give you some, you know, story right at the buy zone for a wave 2 before a generational breakout, right? So, you know, retail extremely bearish on Credit Suisse at the absolute, you know, perfect time to buy and ride to pretty conservatively 70, right? And that's something we don't talk about. 70 is the conservative wave 3 target. I really don't even need to, project beyond that. But once credit squeeze is above this wave B high, like, look out. Right? I don't know about you. I don't have much exposure to the regional banks, right? Maybe that's a personal flaw. Credit squeeze has really helped me remedy that. And then, for the more leap side of the equation, I think credit squeeze goes on 1, 2, and then wave 3 is the 161.8% extension of wave 1. That would take credit squeeze to about, 20. We'd have a shallow wave 4 correction, and then we go on a 5th wave higher. Let's see, where's my 23.6? And then we go on a 5th wave higher from this wave 4 box. I've got too many tabs open right now, but this is 23.6. And I think that pretty conservatively, we see credit squeeze go on a 5th wave higher. I could see, towards the middle of 2022, maybe even towards the end of 2021, but definitely towards, the middle of 2022, that credit squeeze goes 1, 2, the length of wave 3, or the 161.8% extension of wave 1 would be the wave 3 target of 20. We'd have a shallow wave 4 correction, between 16 and 14, and then go on a 5th wave higher. I can see credit squeeze towards the end of 2022, reaching this 25 target. The options market says it has the juice to do it. Now, what's the only problem with credit squeeze? Well, really, the true invalidation level is all the way down at that March low of 6.47, right? That's pretty low. I can, zoom in and see, if there's a better level, this low of 9.28 would be a pretty tight stop. A little wider stop would be 7.33, but really, the invalidation level is all the way down here at about 6.47, and that's really the only flaw with the credit squeeze setup. Otherwise, I love it. Realistically, if credit squeeze went lower, I'd continue to accumulate. I love this long-term play, but that's credit squeeze. All right. It's what y'all been waiting for. We're going to get into some sexier stocks now, okay? The software stocks, the SPACs, the electric vehicles. All right, let's have some fun. This is Fastly. I talk about Fastly. Oh, man. All right, I think we're finally ready for Fastly to be, a true setup because we have this low right here that, we can kind of trade against. This low of about 39, but really the 78.6% retracement of this wave 1 of 37 is going to be the stop in the invalidation. This is Fastly. It goes 1, 2, 3, 4, 5. Large degree wave 1, A, B, C correction right in the 61.8 to 78.6% retracement. We talked about a lot of software stocks in my last video, from Salesforce to Zoom, to Octa to Palantir. The whole sector looks ready to blow up. I think it's in the longer term picture, Fastly's the horse, but this is a 1, 2, 3, 4, 5, large degree wave 1, and A, B, C correction is the large degree wave 2. The length of wave 1 placed at the wave 2 low is going to take Fastly all the way to about 165, right? That sounds nutso, right? That sounds nutso. And I don't even, for time target, this is the long-term investing video, okay? For time target, as crazy as it sounds, this move, right, this crazy run is only 7 months, okay? If this is wave 1, or we talked about in my last video how Datadog had made these exact same lows and these exact same highs on the exact same date, right? Datadog and Fastly, 7 or 8 months from now, I expect we'll go on this wave 3 rally. Now, the time target is not that Fastly will reach 165 in 7 to 8 months. I think a year from now is, a little more conservative that Fastly has an explosive reaction from this box. But really, I like Fastly as a long-term hold, and here's why. If Fastly goes to 165, that's just the conservative wave 3 target, provided it holds above 37 to 39. Fastly above 37, I expect it will go to 165. Here's why the long-term approach is the better one, because that's the conservative wave 3 target. The wave 4 correction retests the wave 1 high, and then the wave 5 is also at least the length of wave 1 placed at this wave 4 low. And as nutso as it sounds, Fastly has a path to 262 in the longer term cycle. So this is really important to understand. Fastly is a growth stock. We're talking about it right now going to 262, right? We talked about Pfizer, in the much longer term picture going to 80 or 90, right? So this is the difference between growth and value investing. The percentage price targets are dramatically higher. So what's that mean? That means the stop losses need to be wider. Okay, the stop loss is always in proportion to the upside price target, right? And even if, right, look at Fastly right now. We're talking about it going to the 260s, right? More than quintupling, right? This is what growth investing can do, but it's also, why growth investing, you have to have some stones, okay? This is not one where you put a 5% stop, right? Or maybe if you're a really active investor, a 5% stop would work. But if an investor puts a 5% stop on Fastly, how likely will they wake up in 2023 with Fastly? Pretty slim to none, okay? And that's not to encourage recklessness. That's just to say growth stocks, the price target is dramatically higher in percentage terms than what a value stock would be, right? So what's that mean? That means the stop loss, the downside level, also needs to be dramatically wider. I think for growth stocks, scaling in, smaller position sizes, diversification, and time horizon, those are going to be the best forms of risk management, okay? Because they're going to do everything in their power to get you out of Fastly. I don't think it goes below 37. I believe it goes the length of wave 1, place of the wave too low. It goes to 165, has a shallow wave 4 correction, then goes on a fifth wave higher to 262. Another software stock, Octa. We talked about Octa a little bit. I think Octa, this may be more of a swing. It also may just be more evidence that software stocks like Fastly and Datadog and Pounder are going to go much higher. But, Octa, very clear. Wave 1, ABC correction, wave 2. So this wave 2 low is the larger degree. This low of 193, I don't want to see broken. The length of wave 1, place of this wave 2 low, is going to take, Octa all the way to about 322. And that's extremely conservative. So within this very conservative wave 3 target, we have a smaller degree count where Octa goes on a 1, 2, 3, 4, 5, wave 1, and ABC correction puts in a wave 2 low. So Octa's low, the invalidation level is 199. The length of wave 1, place of this wave 2 low, could take Octa to 308. That could happen as early as September. Now, I talked about Octa in this range. I always talk about how for options, for leaps, for any type of options play, I'm always in it with an even number. So if it's up 100%, I can sell half and make it risk-free. That definitely happened during this run. Okay, but even Octa is a new setup. I really like where the length of wave 1, place of this wave too low, conservatively is going to take Octa to about 308. That also lines up with the larger degree count where the length of wave 1, place of the wave too low, takes Octa to about 322, right? And that's just the very conservative wave 3 target. We have a shallow wave 4 correction, and then Octa goes on a fifth wave higher, as high as 400 in the longer term cycles. I'm not sure Octa, I think Fastly is better than Octa. I like Octa, more as a swing, but I also like Octa just a lot as evidence, for the rest of this software sector, going higher. I want to see it hold this wave too low of 199 and this wave too low of 193 for now. Okay, but I love Octa, as evidence for the software sector. Let's get into some, a little more software stocks. This is Alibaba. I love Alibaba right here. This is, one of the large cap giants in this video. I don't have many large cap giants in this video, but Alibaba, large wave 1, wave 2. I think the more important count is a 1, 2, 3, 4, 5, wave 1, and an ABC correction puts in a wave 2 low. We talked about in my last video how, this run from 330 to about 1030, almost exactly 7 or 8 months, which lined up with Wayfair. Wayfair and Alibaba, very similar business models, very similar country. I'm not sure if they have similar business models. They're just in the same sector, okay? Fundamental analysis, I focus on the technicals, okay? But this is a 1, 2, 3, 4, 5, large degree wave 1, and ABC correction puts in a large degree wave 2 at exactly the 61.8% retracement of wave 1. I believe Alibaba will hold above the 78.6% retracement of 184, go the length of wave 1, place of the wave 2 low, and Alibaba will reach 355. Now, this is just like Fastly, where I think the more conservative, the more longer term view is the better one, because that's the conservative wave 3 target. We have a shallow wave 4 correction. We go on a fifth wave higher. I believe there's a path right now that takes Alibaba into the 450s, into the 500 range, for the longer term oriented hypothetical investor. But this is a 1, 2, 3, 4, 5, large wave 1, and ABC correction puts in a large wave 2 at exactly the 61.8% retracement. I don't believe Alibaba will go below 184. If it stays above 184, the next target is going to be 355 to 378. That's the conservative wave 3 target. We have a shallow wave 4 correction. We go on a fifth wave higher. Huya, all right, this is another Chinese software stock. Hasn't quite gone the way I wanted it, but if you enter it as a long-term, or if I enter it as a long-term investment, it can stay a long-term investment. What you don't want to do is enter it as a trade, and then change it to a long-term investment. But I think it's also just as bad to do the opposite, enter it as a long-term investment and turn it into a trade. Huya looks really pretty. Wave 1, A, B, C correction puts on a large wave 2. Another 1, 2, 3, 4, 5 impulse puts in another wave 1. Huya has an ABC correction. It puts in another wave 2 low. So, I guess one of the good things about Huya, it's got a pretty clear invalidation level right now. We don't want to see it go below 11.78. If it doesn't, this large degree wave 2 low is in. The next stop for Huya is the 161.8% extension of wave 1, which is 51, right? So this is another example of a growth stock having a dramatically higher, percentage-wise price target. So that would be the conservative wave 3 target. Huya would have a shallow wave 4 and then go on a 5th wave higher, which would take it all the way to, I need to put in 23.6. So Huya would have a wave 3 impulse to about 51. Okay, it's currently at 15. We're talking about this more than tripling, right? More than 300% if it's above 11. If it's above 11.78, the next wave 3 target is the 161.8% extension of wave 1. We have a shallow wave 4 correction. We go on a 5th wave higher, which is at least the length of wave 1, places the wave 4 low. And I believe there's a path that takes Huya in the longer term cycles into the 60s. Okay, it's at 15 right now. We are just talking about it right now, going on a 400% rally. Okay, so this is an example of a growth stock having a much higher price target. So typically, from a stop loss perspective, you got to be a little lenient. Okay, but I do believe Huya is going to break above this high, and it's going to confirm that this was all basing. It's going to break above the IPO high and form a cup and handle pattern, which would take the form of a wave 3 and wave 4 correction, then go on a 5th wave higher into the 60s. So in the longer term cycles, if Huya is above 11, it has a path right now for a 300 to 400% rally. So I like Huya. I like Alibaba. We'll get into the electric vehicles and the solar stocks right now. This is Li Auto. Okay, so before I get into Li Auto and before I get into XPEV, these are really good setups, but I'm bullish a lot of names in this sector. Okay, I'm bullish Lordstown Motors. I'm bullish Nikola even. I'm bullish QuantumScape. I'm bullish Acromoto. I'm bullish a lot of names in these sectors. Li Auto and XPEV just have the pretty clearest setups right now, the most defined levels. But why am I bullish all those stocks, right? Is that a reckless thing to say? All of these stocks that I just mentioned go 1, 2, 3, 4, 5, and now they're forming this, this ABC correction and putting in this wave 2 low. They're all kicking out right now. The retail investors, I believe they're all forming this huge base, and I believe they're all being accumulated right now. But QuantumScape, Nikola, Lordstown Motors, right? Every single one of them goes 1, 2, 3, 4, 5, and that's an impulse structure that they form. And I believe they're kicking out, the retail investors. They've been accumulated during this time, and I believe they're going to go on a wave 3 higher. So I'm very bullish the electric vehicle sector. That's not from a fundamental perspective. That's from the fact that all those stocks I just mentioned go 1, 2, 3, 4, 5, A, B, C, and Li Auto and XPEV, they just have the clearest levels right now. So for Li Auto, this is a wave 1, an A, B, C correction puts in a wave 2 low. The length of wave 1 places this wave 2 low. Very conservatively, it's going to take Li Auto to 49. Let's see this low of 15.98 hold. Remember, 49 is the conservative wave 3 target, right? That's the very conservative wave 3 target because wave 3 and LA wave 3 is bigger, stronger, and faster than wave 1. The length of wave 1 placed at the wave 4 low would be the 5th wave target. And as crazy as it sounds, there's a path right now that takes Li Auto into the 70s, okay? And that is just wave 5, and we're very early into Li Auto's life cycle. So generally, in investing principle, the more recent the IPO, the higher the risk return, okay? And that's because when Li Auto eventually gets 1, 2, 3, 4, 5, that's going to form a large degree wave 1, right? And the cycle will, kind of expand. We're in the very early stages of Li Auto's life cycle right now. So this is 1, 2, 3, 4, 5, large degree wave 1, and A, B, C correction forms a large degree wave 2. Li Auto goes wave 3, wave 4, wave 5, and that's going to form a larger degree wave one, right? That's why, the more recent the IPO, the higher the risk, the higher return, because if Li Auto goes wave 3, wave 4, and wave 5, that's going to complete a larger degree wave 1, and then we'd have a wave 2 correction before going on wave 3, wave 4, and wave 5 higher much further down the line, right? But I believe, when we get to that much further down the line, that this whole chart right here is just going to be a blip on the larger degree cycle, okay? I really believe that. Here's XPEV. Another example, nearly identical to the date, is Li Auto. 1, 2, 3, 4, 5, large degree wave 1, A, B, C correction, large degree wave 2. The length of wave 1 places this wave too low. It's going to take XPEV all the way to 79, right? It's just like Li Auto. That's the conservative wave 3 target. We have a shallow wave 4 correction. We go on a 5th wave higher, which is at least the length of wave 1. I believe there's a count right now that takes Li Auto, it takes XPEV into the 120 range, right? So just like Li Auto, there's a pretty clear path to me where this stock goes on a 300 to 400% run. So the further the price target, typically the more lenient, an investor has to be with the downside levels to make sure that they can hold it, okay? But this is XPEV, wave 1, ABC, wave 2. The length of wave 1 places this wave 2 low will take XPEV on a wave 3 higher to about 80. We'd have a shallow wave 4 correction. We'd go on a 5th wave higher, right? As always, that would be the conservative wave 3 target. We have a shallow wave 4. We go on a 5th wave higher. I believe there's a path where XPEV and Li Auto go up 300, 400%. I believe, Lordstown Motors, Nikola, QuantumScape, Acromoto, a lot of the electric vehicle sector would be, accomplishing that same feat with them. Okay, so last stock, another clean energy stock I really like is Polar Power, ticker symbol POLA. This is a 1, 2, 3, 4, 5, large degree wave 1, an A, B, C correction puts in a large degree wave 2. Now Polar Power goes on another 1, ABC, wave 2 low. It hasn't broken below this low of 7.97. I don't think it will, but I really like Polar Power. It forms a large degree wave 1, an ABC correction puts in a large degree wave 2. This is a solar energy company. The length of wave 1 places this wave too low will take it all the way to 37. I love this as a long-term hold, right? And just like a lot of the electric vehicle stocks we just mentioned, Polar Power reaching 37 is the conservative wave 3 target. It has a shallow wave 4 correction, and it goes on a 5th wave higher. So I love Polar Power. I love a lot of the clean energy sector. And I think some of these smaller cap names, are really great ways for investors hypothetically to get exposure to it. So Polar Power, like Li Auto, like XPEV, that would be the conservative wave 3 target. We have a shallow wave 4 correction. We go on a 5th wave higher, which is at least the length of wave 1, replicated again. So I love the electric vehicles. I love the silver miners. I love the gold miners. I still love the cryptocurrencies, and I love, the commodities plays. I love Pfizer. I love Merck, and I love